Hello and welcome back to GoldTime Tracker, the channel where we bring you the latest, most critical updates on gold, silver, and precious metals straight from the market trenches. I'm Dennis, and today I need you to stop everything, put away distractions, and pay very close attention, because what I'm about to reveal changes the rules of the silver market in a way that will impact every investor, trader, and industrial user. It's Monday, January 19th, 2026. And while most of the world was sleeping, worrying about weekend price movements, a seismic shift occurred behind the scenes. The United States government has just signed off on a massive $2.5 billion acquisition program targeting critical minerals. And at the very top of the list, silver. This is not speculation. This is a strategic move by the world's most powerful buyer, one that will fundamentally alter supply dynamics, disrupt the COMEX, and create a scenario where the old market rules no longer apply. If you're looking at the paper price of silver hovering around $93 on your screen, thinking you understand the story, you're only seeing the background noise. The real headline is far more critical. A new player, the United States government, has officially entered the market with a bottomless wallet, purchasing silver not for profit but for national security. Missiles, satellites, and the entire green energy transition depend on securing this metal. And when a sovereign power acts with this kind of mandate, price becomes irrelevant. Today, we're going to break this down for you. We'll look at why this $2.5 billion buy program matters, how it compares to the available physical silver, and why it signals the beginning of a just-in-case economy. We'll examine what's happening on the COMEX vaults, how major banks like JP Morgan and Bank of America are positioning, and why Shanghai's premiums are flashing warnings that the West can no longer ignore. By the end of this video, you'll understand why the paper price is no longer a reliable indicator, why physical silver is about to become scarce, and what every investor should do to protect themselves before the market reaches a breaking point. The clock is ticking, the window is closing, and this is your front row seat to one of the most extraordinary events in the history of silver markets. So, buckle up, stay focused, and let's dive into the numbers, the strategy, and the urgent market signals that are already reshaping the global silver landscape. As we continue, you need to understand the real crisis behind the numbers. While the paper price of silver might look stable at $93, the COMEX vaults are under extreme stress. January is supposed to be a quiet, non-delivery month, a time when only a few contracts change hands. But this January, the janitors are gone and the looters have arrived. According to the latest reports, 41.44 million ounces have already been pulled from the COMEX registered inventory in a single month. That's 8,288 contracts, and it's happening in a month that should barely register activity. This is not normal. This is a run on the bank, and the implications are staggering. The story becomes even more intense when you look at the daily delivery reports. On one day alone, 345 delivery notices were issued, demanding actual physical silver, and on the receiving end, JP Morgan stopped 340 of those contracts. That's 98.5% of the activity, a single bank effectively controlling almost the entire flow of physical silver. On the issuing side, Bank of America was bleeding, trying desperately to find metal to meet obligations. This is a battle between banks, JP Morgan as the vampire, Bank of America as the victim, and it's a prelude to what's coming when the U.S. government's $2.5 billion program hits the market in full force. Here's why this matters to you. The registered inventory, the silver that is fully warranted and ready for delivery, is only about 120 million ounces. If January alone drains 41 million, simple math shows that less than 3 months of supply remains at this rate. By April, when the primary delivery cycle begins, the system is at risk of hitting zero. This isn't fear-mongering, it's arithmetic. And when the COMEX cannot deliver, contracts are subject to a legal loophole called force majeure, which allows exchanges to settle in cash rather than physical metal. That's when paper holders get a check while the real physical price explodes elsewhere. Meanwhile, the U.S. government is entering the market, not with speculation, but with necessity. Their mandate to secure silver for national defense, satellites, and green energy infrastructure is non-negotiable. Price is irrelevant. Budget limits are irrelevant. And when a sovereign enters with this kind of authority, it creates a self-fulfilling prophecy. Industrial buyers, tech companies, and solar manufacturers panic. If the Pentagon is buying, they must too, or risk losing supply for their operations. The physical metal becomes a battlefield, and retail investors are caught in the crossfire. And don't forget, while this is happening in New York, Shanghai is pulling metal east. The arbitrage gap, the difference between the COMEX price and the Shanghai premium, is now over $12 per ounce. Every ounce that could have been delivered to the West is being diverted to China. This puts additional pressure on the COMEX, accelerates the inventory drain, and makes the paper price a dangerous illusion. In short, the COMEX is no longer a market. It's a countdown clock. The combination of bank wars, government intervention, and arbitrage-driven eastward flows means that physical silver is disappearing rapidly, and the system is structurally unable to cope. Retail investors, small buyers, and even large funds are now competing with banks and governments for a shrinking pool of metal. If you think you can wait for a pullback, think again. The math is already set and time is running out. Now, let's shift our focus east to Shanghai, because this is where the physical reality of silver is hitting the West with full force. While the COMEX tries to keep the paper price at $93, the Shanghai market is flashing a $15 premium, pushing physical silver prices over $105 per ounce. That's a $12 arbitrage gap, a glaring signal that the paper market is broken. Every ounce that could flow to New York is now being diverted to the highest bidder in China, and this creates a vacuum effect. The metal flows east, leaving the COMEX vaults drained, and every day the registered inventory inches closer to zero. Here's the kicker. Regulatory efforts in Shanghai to cap purchases, slashing position limits from 7,000 lots to 3,000 lots, were supposed to slow the rally. Normally, this would scare traders and push prices down. Not this time. Industrial giants, particularly solar panel manufacturers who rely on silver for 80% of global production, cannot stop buying. Factories cannot pause, contracts cannot be broken, and workers cannot be sent home. The regulation became a buy signal, reinforcing the scarcity and intensifying the arbitrage pull. The COMEX is effectively losing metal faster than it can measure, and the paper price becomes less relevant by the hour. This isn't just institutional panic. The retail market is starting to fracture too. Let's talk about AppMex, the largest online bullion dealer in the United States. Over the weekend, their CEO, Ken Lewis, circulated a letter to major clients admitting that the private mint is failing. Production has collapsed by 50% overnight, while demand has surged 400%. Their solution? A $500 minimum order for silver, prioritizing bulk buyers and shutting out small investors entirely. If you're a casual buyer, saving $50 a week for a silver eagle or a generic round, you are now locked out. The retail supply chain is breaking, and the little guy is being systematically excluded. What this means is clear. The market is bifurcating. Whales, institutions, and governments are gobbling up physical silver, while retail investors are hit with artificial scarcity and rising premiums. AppMex is just the canary in the coal mine. Local coin shops are running empty, mints are shutting down, and the supply chain is collapsing under unprecedented demand. This isn't a temporary blip. It's a structural failure, a domino effect triggered by both the COMEX drain and the government's $2.5 billion buy program. Now imagine combining the two forces, eastward arbitrage plus retail exclusion. The effect is devastating. Every ounce that moves to Shanghai leaves fewer bars for the West. Every delivery notice stopped by JP Morgan accelerates the scarcity, and every retail freeze increases panic buying. Small investors scrambling to buy coins push the premiums even higher, while institutional and government buyers clear out vaults before you even get a chance. The math is brutal, and the clock is ticking toward April 2026, when the primary delivery cycle could hit zero registered silver. In essence, the market has mutated. Paper contracts are no longer a reliable representation of real silver. Registered inventories are draining at record speeds. Retail investors are locked out. Industrial demand is relentless, and the arbitrage gap signals that physical silver is moving faster than the West can track. This is the stage where the COMEX becomes irrelevant. Shanghai dictates the real price, and only those holding actual metal, bars, coins, and allocated vault storage will be positioned to survive the upcoming market collapse. The takeaway for viewers is simple but urgent. If you want exposure to silver in this environment, physical possession is no longer optional, it's survival. Waiting for a paper pullback or a dip in COMEX prices is a losing strategy. The supply is vanishing, and the arbitrage between East and West is a warning siren that the era of easy, accessible silver is ending. As we move deeper into 2026, the timeline becomes critical. January has already ripped through 41 million ounces of silver from the COMEX vaults, numbers that normally belong to a dormant, non-delivery month. February, another so-called quiet month, is expected to drain at least 30 to 40 million ounces as industrial users scramble to front-run the government's $2.5 billion buy program. That leaves roughly 80 million ounces heading into March, but the open interest for March contracts is already pointing to demand exceeding 300 million ounces. The math is stark, 80 available versus 300 demanded. The system is heading for a physical default, and nothing can prevent it. This brings us to the dreaded term, force majeure. Most investors skim past it in their futures contracts, thinking it's legal fluff. They are wrong. This clause is a trapdoor. It allows the exchange to declare that physical silver cannot be delivered due to circumstances beyond their control, be it government intervention, supply collapse, or market chaos, and to settle contracts in cash instead of metal. Imagine buying 5,000 ounces at $93 per ounce, only to be handed a check for $93 while the street price for physical silver rockets to $200, $300. You're technically made whole on paper, but in reality, you're wiped out. The paper and physical markets diverge, and holders of cash lose while holders of metals survive. JP Morgan is already preparing for this moment. They stopped 340 of 345 delivery notices in January alone, effectively cornering the vaults. They are positioning themselves to be the ultimate beneficiary when the force majeure clause hits. Meanwhile, Bank of America and other shorts are bleeding, desperately trying to source metal they cannot deliver. The institutional collapse is quietly building, while retail investors face their own nightmare. Dealers like APMEX have instituted $500 minimum orders, prioritizing bulk buyers and locking out small investors entirely. Local coin shops are empty, mints are failing, and the system is showing cracks everywhere. The combination of government buying, institutional cornering, and retail freeze creates the perfect storm. The U.S. government enters the market with a bottomless wallet, JP Morgan hoovers up the COMEX metal, and Shanghai continues to pay $12 per ounce more than New York. Arbitrage pulls more metal east, draining the West further. By April, registered silver could hit zero, triggering force majeure and leaving the paper market in chaos. Those holding physical silver bars or coins will have the only real claim on metal, while paper holders will be left holding worthless contracts. Think about what this means for anyone still on the sidelines, waiting for a dip, hoping for a pullback, or relying on COMEX prices is financial suicide. The price on the screen is meaningless. The real price is determined by physical availability, and that supply is evaporating. April is the critical month, the moment when theory collides with reality. The arithmetic of the COMEX delivery schedule ensures that paper cannot meet demand. The system is designed to fail under this type of stress. The retail freeze and institutional scramble are merely the prelude to the final act. This is why we call it a hostile takeover of the global silver supply. The government, JP Morgan, and other major players are colluding indirectly, though not maliciously. They are all acting in self-interest. But the result is clear. The retail investor is being systematically excluded. Paper contracts are being trapped, and physical silver is being hoarded in fewer hands. The window to act is now, and anyone ignoring these signals is risking total exclusion from the market. The lesson for viewers is urgent. Understand the April deadline, recognize the force majeure trap, and position yourself in physical silver, not paper. Every ounce you secure now is protection against a market implosion where paper contracts fail and premiums explode. The countdown has begun, the COMEX is bleeding, Shanghai is pulling, and the US government is buying like there's no tomorrow. Now that we've mapped the institutional battlefield, it's time to look at the retail side, where the consequences of this unfolding crisis are hitting Main Street hard. The largest online bullion dealer in the United States, AppMex, has just admitted internally that they are experiencing a demand surge 4 times their normal volume. Under normal circumstances, this would be great news for business, but in the current environment, it's a catastrophe. Their private mint has suffered a significant supply collapse. Production capacity is down 50% overnight, while demand is up 400%. The result? A frozen market where small investors are effectively shut out. To manage the chaos, AppMex has imposed a $500 minimum order for silver purchases. This is more than just a marketing tactic, it's a hard rationing mechanism. Small investors, saving $50 or $100 a week to buy coins or rounds, can no longer participate. The system is prioritizing whales and bulk buyers, who are the only ones capable of navigating the bottleneck. Expect this minimum to rise in the coming weeks, potentially reaching $1,000 or $5,000, and eventually, products may simply disappear from the site entirely. This is the real-world manifestation of the COMEX and Shanghai dynamics we discussed earlier. Physical silver is being siphoned off faster than it can be produced, leaving only institutional and government buyers with access. The arbitrage between New York and Shanghai is another critical factor. Paper silver may still show $93 on COMEX screens, but in Shanghai, the same metal commands $105, $110, a 12 plus per ounce difference. That spread is like a magnet, pulling every ounce of available metal eastward. Miners, refiners, and vault operators are all looking at the higher price in China. The metal flows to the highest bidder. This is why COMEX inventories are collapsing. JP Morgan is stopping deliveries to hoard physical metal, while the U.S. government's $2.5 billion buy program is accelerating the drain. Meanwhile, retail mints like AppMex are caught in the middle, unable to secure feedstock and forced to ration. For small investors, this is a wake-up call. Waiting for a pullback or hoping to buy at the screen price is no longer viable. By the time a coin becomes available, it may carry a massive premium, far higher than anything currently listed. The shortage is not temporary, it's systemic. Every ounce that flows into the hands of JP Morgan, the Department of Defense, or Chinese industrial buyers reduces the available supply for ordinary investors. The retail freeze, combined with the institutional hoarding, is a self-reinforcing cycle. Less supply leads to higher prices, which drives more panic buying, which further tightens supply. The global picture is equally dire. Silver mines in Mexico are facing strikes, reducing output. Peru and other South American producers are struggling to maintain exports. Supply chains are breaking under geopolitical pressures, and the U.S. government has now declared silver a strategic national asset, making acquisition non-negotiable regardless of price. The combination of these factors has created a market where physical possession is everything. Paper contracts, ETFs, and promises of delivery are no longer guarantees. They are bets on an increasingly fragile system. In this environment, the concept of price discovery is breaking down. The COMEX price is no longer a reflection of real-world scarcity. It's an artificial construct maintained by those trying to delay the inevitable. Meanwhile, Shanghai, physical mints, and government programs are telling the truth. Silver is scarce, strategic, and in demand. Retail investors who fail to understand this may find themselves priced out completely, left holding cash or paper while the metal becomes increasingly unobtainable. So what should viewers do right now? The lesson is clear. Focus on physical silver. Act decisively and understand that premiums and shipping costs are the price of survival. The longer you wait, the more the system locks you out. This is not hype. It's arithmetic, logistics, and policy converging into a perfect storm. By April, when the force majeure clause could be triggered on COMEX contracts, the gap between paper and physical silver could explode, leaving latecomers completely excluded from the market. Small orders, paper positions, and hesitation will cost you dearly. Institutional buyers, the U.S. government, and international arbitrageurs are already absorbing every ounce they can find. Retail investors must act now, secure physical metal, and prepare for premiums to spike further. The combination of COMEX drain, Shanghai arbitrage, and APMEX minimums creates a market where hesitation equals exclusion, and exclusion equals losing the opportunity of a lifetime. We've reached the final chapter of this unprecedented story, and if you've been following carefully, the picture could not be clearer. We are standing on the edge of a market fracture unlike anything seen in decades. COMEX registered silver is disappearing at a pace that math cannot ignore. JP Morgan has already stopped 98% of delivery notices, cornering the physical metal before the U.S. government even clears its $2.5 billion acquisition program. Meanwhile, Shanghai is signaling a premium that cannot be ignored. APMEX has frozen small orders, and supply chains are failing. If you are still thinking in terms of charts, trend lines, or paper contracts, you are already behind. Here's the reality, plain and simple. The retail investor is being locked out. $50, $100, even $500 purchases are no longer viable paths to secure metal. The new market rules prioritize whales, institutions, and sovereign buyers. By the time April arrives, the force majeure clause could be invoked, allowing COMEX to settle contracts in cash only, leaving paper holders with nothing but a check while physical silver skyrockets. If you hold paper contracts, you risk being cashed out at $9,300 per ounce, while real physical silver trades at $200, $250, or higher. This is not a prediction. This is arithmetic, policy, and supply chain reality converging. So what does this mean for you, the GoldTime Tracker audience? The first priority is to secure physical silver now. Stop waiting for dips or trying to time the market. Premiums, shipping fees, and scarcity are the price of admission to the lifeboat. If you wait, you will be forced into cash settlement while others hold the actual metal. Physical possession is the only protection against the collapse of the paper system. Every ounce you can secure today is an ounce that cannot be confiscated or printed into oblivion. Second, understand that this is not hype. It's a systemic shift. The U.S. government has officially labeled silver as a strategic national asset. This is not a speculative purchase. This is national security policy, and its implications for the market are seismic. When a sovereign buyer enters a market with an infinite wallet, the rules change. Prices are no longer determined by trends or charts. They are determined by need, scarcity, and government mandate. Retail investors who ignore this risk will be completely excluded. Third, diversify where possible, but stay within hard assets. While gold remains essential, Silver is the key play right now due to the shortage and strategic imperative. Keep in mind, paper ETFs or futures are vulnerable. Real physical bullion, bars, or rounds that you hold in your possession is the ultimate safeguard. This is the principle that separates the prepared from the casualties when force majeure and government hoarding collide. Finally, let's talk about timing. The calendar is your enemy. January already saw 41 million ounces drained from COMEX. February is expected to accelerate that depletion. By March, primary delivery month, the numbers point to a severe shortage, potentially leaving registered inventories far below open interest. April is when the paper system may officially fail, triggering cash settlements while physical silver commands astronomical premiums. Delay is no longer a strategy, it's a risk multiplier. Before we conclude, a crucial reminder. I am Dennis from GoldTime Tracker, and this is educational and informational content only. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell silver or any other asset. The silver market is volatile, and physical assets carry risks, including storage, liquidity, and premiums. Always do your own research, consult licensed professionals, and understand your personal financial situation before making any investment decisions. To wrap up, the evidence is overwhelming. Registered COMEX silver is draining, Shanghai premiums are exploding, retail supply chains are failing, and the U.S. government has entered the market as a sovereign buyer. The forces at play are converging toward April 2026, creating a once-in-a-generation scenario. The takeaway is simple: act decisively, secure physical assets if possible, and respect the arithmetic of supply and demand. Hesitation now could mean permanent exclusion from the market and missed opportunity. The window is closing, the whales have arrived, and the vaults are emptying. This is your final warning, and GoldTime Tracker will continue to monitor every twist in this historic story. Stay vigilant, stay informed, and stay ahead of the curve.